So this happened last week. Fed will not change interest rate. Currently, it's at 3.5% to 3.75%. The Fed committee raised assessment of economic growth and some easing of concerns about labor market. So all of these brings good news. At the post-meeting statement, Fed mentioned that indicators now show that economic activity is expanding at a solid pace and unemployment rate is stabilizing. But at the same time, inflation is still high, which also means cutting of interest rates will be delayed. So about Jerome Powell, he has 2 more meetings, and currently he's facing some investigations about the renovation of central bank's headquarters. But more importantly, the market is keen to know who the next Fed chair will be. So back onto interest rates. Inflation is currently still running closer to 3% than the Fed's 2% target. So this is causing concern amongst the Federal Committee team. Markets are expecting that the next cut will likely be in June, the mid-year. So on to the U.S. government shutdown. It's likely to be a short one. This is because of the delay of voting, even though the Senate passed the deal. That includes a package of 5 bills and a 2-week stopgap. Basically, this allows lawmakers to have more time to work out the disputes over the fundings. But the House of Representatives need to vote as well, which will happen early this week. So because the votes are not fully cleared yet, the government will go into shutdown, but likely to be a short one. Onto the candidate for the next Fed chair. Investors largely approved Trump's pick for Kevin Warsh. But this is not confirmed. He's just a good nominee. This needs to be confirmed by Congress likely sometime before mid-year. Jerome Powell will end his term in May this year, so the selection will likely conclude before then. Kevin Warsh, as a candidate, eased some concerns about the Fed's independence. Furthermore, he has experience as a Fed governor and has strong stance against inflation. So while markets feel that he'll likely to push interest rates lower, many expect him to maintain Fed's independence from the government. Then, you can see U.S. dollar rallied, and then U.S. Treasury held steady. So these are signs that show investors are happy with this pick for the time being. So earlier this year, you should see Sell America because of Greenland and Trump's threat on the NATO countries that provided help with tariffs. But Trump eventually backed off because gold is a natural hedge against geopolitical tensions. Well, and along with inflation and U.S. dollar weakness, hence, the prices skyrocketed. Then, now, the opposite happened. Gold, and also silver, experienced a sell-off at late January and at the start of February. This is because of the firmer dollar, from the recovered confidence in the U.S. economy due to Kevin Warsh being a nominee for next Fed chair, which improves the outlook of future interest rate cuts. And then also, obviously, profit-taking, as gold prices are already very high. There's no surprise to see profit-taking activities. A stronger dollar also makes it less attractive for foreigner gold buyers because gold is usually linked to U.S. dollar. And one more thing is there's likely a possible deal with U.S. and Iran. So these also eased geopolitical concerns. So now on to EU. The European Central Bank said that the euro area is currently at a good place. But as the euro starts to strengthen further and further, some areas in the EU zone are feeling uneased. We'll cover the reasons in the next slide. But at next, if euro strengthens further, chances of interest rate cut in March will increase, which is good news. So let's see why, when euro strengthens, why will people worry? Firstly, Europe is a very export-heavy economy. They manufacture a lot and then sell to other countries. So euro-priced goods and services will then be more expensive for US and also to US dollar-linked buyers, which is very common. This will hit the euro area exporters' profits as the buyers might buy lesser. There might be a drop in volume and hence profits, especially sectors that are very price-sensitive to global demand. Broadly speaking, precious metal, oil, auto parts, and airplanes. Next, many euro area multinationals, the MNCs, tend to earn in dollars. So when converting from dollar to euro, these MNC might see a drop in revenue and profit. And then, many commodities are priced in US dollar. So similarly, when converting back to euro, you'll see a currency conversion lost. And lastly, when euro keeps strengthening, euro area might fall into deflation. While this seems to be good, but keep in mind, euro area inflation is already at their target, the 2% target. Now it's 1.9%. But if it drops lower and lower, you'll see it happening like China. The main reason why disinflation is bad is consumers and companies will delay spending. Because to them, the mindset is why buy now if it's cheaper later? So all of the big ticket items and investments, they'll then wait and wait. They'll wait for a later time to purchase. This will drive demand downwards, which will hurt corporate profits. So these are the reasons why if euro strengthens further, it's better for the central banks to cut interest rates, which allow a friendlier environment for businesses to continue, sustain, and grow. So China and UK, they, after many years, finally met for partnership discussion. For some background, between the two, there were talks revolving around national security, challenging business climates. UK businesses in China flagged that it's challenging to operate in China and vice versa. The other way as well, China businesses in UK and China plan to expand cooperation and work on key areas like education, healthcare, finance, AI, bioscience, and energy. China will also consider opening visa-free entry for British nationals and urged UK to have a fair environment for Chinese companies to operate in there. Other than UK, China is also hosting talks for partnership agreements. The recent one is between Canada. You'll see that China is very proactive in building alliances. And on to the last one, India. Previously, Trump applied really high tariffs on India, like 50% high. The two recently had a trade deal. US will cut tariffs on Indian exports. The reciprocal tariffs on India exports will be cut to 18%, a 7% drop. And India will reduce the barriers against US businesses. Trump also mentioned that India agreed to stop buying Russian oil and buy more from the US. When combining this recent trade deal with US and the recent one between India and EU, this will bring a lot of optimism. These will likely be the strongest external stimuli for India economy this year. Now let's look at the stock market. You'll see the Nifty 50 increased recently. The whole of 2025, Indian equity market was the weakest performer among emerging countries. Just looking at MSCI India Index, they only gained 4+% last year compared to the entire MSCI emerging market, which grew almost 34%. So with the drop in tariffs, it's very good for exports in India. Now looking at the GDP contribution pie chart on the right, India is quite export-heavy driven, about 1/3. Agriculture, fishing, mining, and manufacturing. All of these sum up to be about 30+% that contributes to India's GDP. So it's good news when tariffs from the US will be tapered downwards.